What does overfunding and overfunding whole life insurance actually mean? You hear from myself or Caleb, other people in the space that talk about overfunding a life insurance contract. And you ask yourself, well, what's the difference between overfunding a whole life policy and a typical whole life policy? Well, in today's video, I'm going to show you exactly the main differences between the two and share with you exactly what overfunding actually means. With that being said, let's go ahead and dive into the numbers. All right, so here are the numbers. We're going to take out two different types of policies that will give us a good understanding of what overfunding versus not overfunding actually looks like. So we're going to look at the typical whole life insurance policy that has zero overfunding to it, right? When we have zero overfunding to it, we essentially are maximizing the death benefit and minimizing our cash value, right? And so what we're doing is the complete opposite. Is we're trying to maximize our cash value and minimize the death benefit. Right, minimizing the death benefit, minimizing the costs of insurance, which then maximizes the cash, which then allows you to borrow against, to use for other asset producing activities, to go build more wealth, to produce more cash flow, to increase your life, to live an intentional life. And so with that being said, let's go ahead and take a look at the numbers from a typical whole life policy. All right, typical whole life policy. You put in $100,000. You have zero total cash value available. You put in another $100,000. You've now put in a total of $200,000. You have $0 available. You continue to do this from a funding standpoint, and you find out, well, how long does it take for me to even have more cash into this policy than I put into it? Well, let's do the math. It shows you here the total money you put into it, and here's the total cash value you have. So in this instance, let's find out. Let's keep scrolling. I actually don't even know. All right, so in this instance, this is year 12. Year 12, we put in 1.2 million, and this is 1.249. And I'll tell you something, this is actually pretty good. I've seen other contracts where you do zero overfunding and you essentially have year 18, 20, for a policy to essentially break even, and break even essentially having more cash value than you put into it from a dollar standpoint. And in this instance, it takes 12 years and we have zero liquidity within the first 2 years. All right, so this is what a non-overfunded typical whole life policy looks like. Now we're going to look at a overfunded policy, and then we'll go into share why one is overfunded versus not, besides the numbers and what actually makes it overfunded. All right, so here's what a overfunded whole life policy looks like. You'll see that year one, same dollar amount, $100,000 going into it, $200,000 the year two total. This is the total amount. You'll see that you have $80,000 of cash value within year one, $168,000 in year two. Remember in the previous contract, we only had zero you only had zero within year two and zero within year one. You finally had about $50,000 in year three. The break-even standpoint, when we have more cash value than what we put in the contract, you'll see that it is at $501 here and $500,000 here. So this contract breaks even at year 5 versus the other one breaking even at year 12. The other thing to point out is this death benefit is $2,500,000. The death benefit in the typical whole life, $7,974,000. So this is the big differences, and why one is has more cash value than the other is the costs in this one are going to the death benefit. The cost in this one minimizes the death benefit, so we have less costs. And in this instance, the money's got to go somewhere else. So if it's not going to the cost of insurance, the death benefit, well, then we can now have it going towards our cash. So what does overfunding actually mean, right? So overfunding is essentially saying that I have majority, or I have more money going directly towards cash through what we call a paid up additions rider. So if your policy in a whole life policy has a paid up additions rider, then that's overfunding. Now, there could be a percentage. You could have 10% PUA, 20% PUA, 30% PUA. So in theory, from an overfunding standpoint, you can have an overfunded policy that could be at 10% PUA, but instead of it being zero, right, you may actually only see like 10 grand in there or 20 grand in there. So there's different levels to overfunding, which I think is also important to realize, because I have seen policies that are overfunded, and even if in year one, you may only see like $30,000, $40,000 available, and it takes 9-10 years to still break even in the policy. So when you're looking at it from that perspective, you have to also be aware that there are different levels to overfunding. So there's going to be two essentially parts to it. There's going to be a base. When I hear the word base, think of the word base as like going to death benefit. And then when I think of PUA as going to cash. So in this policy here, 100% of this is base, $100,000. All of it is directly to base. That's all going to the death benefit. When we're looking at this example here, we have about 15% of our funds going towards the death benefit of our base, and then 85% of it is going towards cash. Okay, so when we're looking at it from a dollar perspective, you have to understand that there's going to be percentages of some that's going to go to PUA and some that's going to go to base. And when you have the ability to have PUA, that is going to be the overfunded piece of it. All right, and the reason why it's also called overfunding is because in life insurance, you have to pay the base no matter what happens. So worst case scenario in this example, every single year you have to pay $100,000. Like that's just it. In the contract, it says you have to pay the full 100,000. However you choose to do that comes from your bank account. You're later on in life, you don't have enough cash value, you can borrow against it, or you can choose to reduce, pay it up, which essentially means you can't put any more money into it and make it zero. But if you want to keep the policy in force and actually continue to grow where you can continue to put money in, you have to pay the full amount in the base. So it's zero flexibility, $100,000, no overfunding, $100,000 just has to go into it. Now, in this example, the overfunding piece is everything above the base because the PUA is everything above the base. So the base in this instance, it's going to use the example, is 15 grand. So we have to make at least a minimum of 15 grand of the example. It's actually a little bit higher. In this instance, it's actually about 17 grand. If you know much about it, you scroll down, if you're an agent, somebody who's professionalized, you would saw that the number below was actually around 17 grand, but just using 15 grand for an easy number. 15 grand is the base to where I have to pay no matter what happens to keep this policy going in force. Now, the other 85 grand is optional. You have the ability to pay up to 100 grand. So you have a ceiling of 100 and a floor of 15, which is great for real estate investors, great for people who have businesses, because not every year you're going to have the same cash flow coming in, and some years may be better than others. And if you have a really, really good year, well, then you can continue to pay the 100 grand. And if you don't have a great year, then maybe you only pay 30 or 40 or 50 grand instead of the full 100 grand. Or if your worst case scenario, you only are able to pay the 15 grand, great. We had built this in to where we have the ability to only pay the base, which is a very, very low number, which also optimizes the cash value and minimizes the death benefit. So I hope that helps. Just to be able to get a quick idea of what overfunding means is essentially saying we have PUA on the policy, but remember, there's different levels of PUA. You want to work with somebody who maximizes the PUA so you have as much cash value as possible to borrow against, use for asset producing activities that produces cash flow to increase your lifestyle to live an intentional life.
Hey, I want to thank you so much for watching this video to the end. This video is on life insurance, and if you have more questions about life insurance, infinite banking, why you should overfund it, we have a link below that goes to our And Asset Vault. This is a free vault that gives you everything you need to know about life insurance. We have case studies, we have a calculator on there, we have a handbook, we have frequently asked questions, we go through a process. I have my masterclass on there. We literally want to be the one-stop shop for every life insurance decision. And so if you want to learn more, click the link below, and we look forward to educating and maybe opening your mind and eyes to the power of life insurance.